We hear about the stock market going up or down every single day, but what even is the market? Well, today we're going to pull back the curtain on the engine that powers it all, the stock exchange.
You hear it all the time, right? Your friend says, "Oh, I just bought some shares in that company." But where? Where does that actually happen? It's not like you can just walk into a supermarket for stocks, so how does it all work?
Well, the answer is the stock exchange. Think of it as an organized, and this is the most important part, a regulated marketplace, where all those shares in public companies get bought and sold millions of times a day.
Okay, so we know what it is, but how does your decision to buy just one share actually connect with someone on the other side of the world who wants to sell it? How does that trade physically happen?
It happens incredibly fast, so let's walk through it. First, you place an order to buy a share through your broker. That could be a person, or more likely these days, just the app on your phone. Then, your broker zaps that order over to the exchange. The exchange's super powerful computers instantly scan for a matching sell order from another investor. And when it finds one, bam, the trade is done. The whole thing happens in like fractions of a second. It's amazing.
The real engine behind all this speed is something called the electronic order book. So you can forget that old image of traders shouting on a chaotic floor. Today, it's all handled by this giant digital ledger that keeps track of every single offer to buy and every single offer to sell for any given stock.
And the way this order book works is actually pretty simple. It's always balancing two things: bids and asks. The bid is the highest price any buyer out there is willing to pay for a share right now, and the ask is the lowest price any seller is willing to accept. The exchange's only job is to match them up.
And here is where the magic happens. The very instant a buyer's bid matches a seller's ask, the system makes the trade. It's kind of like an electronic handshake. It locks in the deal at a price both sides agreed on without them ever needing to know who the other person is.
Now, this whole system isn't just one single giant computer somewhere. It's actually a global network of major exchanges, and each one lists its own set of companies. Let's look at a few you've probably heard of.
You've got the super famous New York Stock Exchange, the NYSE, one of the oldest and most prestigious. Then there's the NASDAQ, which was the first all-electronic stock market and is home to a ton of the big tech companies. And up in Canada, the main marketplace is the Toronto Stock Exchange, or the TSX.
So, why do we even need these massive, complex exchanges? Why go through all this trouble? Well, it really boils down to one single, incredibly important word: trust. Exchanges provide the whole framework that makes investing safe and fair for all of us. Let's break down how they build that trust.
You can think of it like this. Stock exchanges have four really critical jobs. They ensure price transparency, they provide regulation, they create something called liquidity, and all of that together builds investor confidence.
Okay, first up, transparency. Since all the bids and asks are publicly displayed for everyone to see, we all get the exact same price information at the exact same time. This creates a fair, level playing field for everyone, whether you're a giant institution or just someone investing on your phone. Next up, regulation. This is a huge one. Exchanges have really strict rules. Companies have to meet certain standards just to get listed, and they have to report their financial results honestly. This is what protects all of us from bad information and, outright fraud. And then there's liquidity. Now this sounds like a complicated finance word, but the idea is actually super simple. It just means you can easily turn your shares back into cash whenever you want. Because millions of people are trading, there's pretty much always a buyer ready when you want to sell. So you see, when you put all of those pillars together, the transparency, the regulation, and the liquidity, that's what creates the final, most important piece: confidence. You can invest your money knowing the price is fair, the companies are playing by the rules, and you can get your money out when you need to. Okay, so let's zoom out for a second and tie this all together with a really simple analogy that I think makes it all click. Honestly, the best way to think about it is like this. An exchange isn't some scary, complicated machine. At its heart, it's really just a marketplace, a lot like a local farmer's market. But instead of trading apples and carrots, people are trading tiny pieces of companies. And in this special market, the prices are posted clearly for everyone to see. That's your transparency. All the vendors, who are the public companies, have to follow the same rules. That's the regulation. And because the market is always so busy, it's always easy to find someone to trade with. And that's liquidity.
And this brings us to what is maybe the most important takeaway of all. The exchange doesn't actually own any of the stocks being traded. It's just the neutral ground. It's the platform with the rules and the technology that lets all of us trade with each other safely and efficiently.
So the next time you hear someone say the market is up or the market is down, you'll know exactly what they're talking about. It's just the sum of millions of trades from people all over the world, all happening inside this incredible system. Every single trade you make passes through a stock exchange, the system that keeps modern investing running every second of every single day.